Hello, everybody. Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation, bringing you another Lessons in Valuation 2-minute drill subscriber request series. Today, we're going to look at a company that I'm really not very familiar with, but I found fascinating to evaluate it from a valuation point of view. So let's go ahead and get into the company. The company is HSBC Holdings, PLC. It's a United Kingdom company. It is A- rated. It does only have 19.61% debt to capital, which I like. It has a very high dividend yield of 6.07%, which could be very attractive, and is trading at a very low valuation. The blended PE is only 8, giving it an earnings yield of 12. But let's look at this stock and analyze it from a valuation and an operating history point of view. First of all, I see a lot of cyclicality, and I see even a long period of time where the company's earnings did not do well. And this would have been a time where the company didn't really make investors any money either. Okay, then we had COVID, and now the stock is starting to look like it's growing again. It's going to be a growth stock again. So it came out of COVID with one down year, and then since then, it's been growing at over 22% a year. But I want you to notice that during this roughly 4.5 year, a little over 4-year period, the market's only been valuing it at an 8 multiple. Okay, when I look at it from the max point of view, there was a time when the market valued it at a premium to the fair value of 11.48 times earnings, which is what this orange line is, based on the fact that it had such low growth. So that usually I like a 15 multiple. This uses the Graham-Dodd formula, and it calculates out at a fair value multiple of 11. Okay, but then as I change these time frames, and this is the dynamic nature of FastGraphs, I see that the stock all of a sudden is with a 7.5 or 8% growth rate. It's valued at a 15 multiple. That's the value of the orange line. But the market has been undervaluing it at roughly a 10 multiple, which is the blue line. And of course, currently it's at an 8 multiple because it's below the blue line. So when I look at it from a forecasting point of view, at a 15 multiple, if it only grew at the 5% rate that the analysts are expecting, then it could be attractive. Now, I'll say one positive, analysts have been raising their estimates over the last 6 months. Okay, and so they're getting more optimistic about the stock. But looking at it from a normal multiple, which has been about 8, which is currently roughly where it's at, then there wouldn't be a lot of money to be made in this stock from capital appreciation, but it still could generate double-digit rates of return because of its generous 6.07% dividend. But for some reason, we're looking for a slight cut in dividend this year, followed by some increases, and that may or may not be true. So anyway, this is HSB Communication. Really interesting lessons in valuation because we see how, as the company cut dividends several times, there's just not a lot of consistency here that I would personally normally endeavor to look for. So anyway, it's been Chuck Carnevale. Hope you enjoyed this video. This is another subscriber request. Don't know very much about this company. Not one that I'd be too interested in just because of the fact that it seems to be very difficult to judge where the company's profits will go in the future. But it does offer a nice current yield, assuming they don't cut it. Anyway, if you like the video, give me a like, ring the bell, subscribe to our YouTube channel, and then also take a look at subscribing to FastGraphs. You can see how it really gives you an informed edge when you're looking at investing in a business as to how that business has historically performed and how it might perform in the future. Thanks for watching.